It is incredibly difficult to become wealthy on a salary alone, because every dollar that you earn is immediately taxed at a combined rate that can reach close to 50%, depending on where you live. If you just hold on to that cash, it decreases in value every day due to inflation. But if you take whatever is left over and invest it into assets, all your cash earnings on those assets are also taxed, which means that you will only ever receive 80% of your actual profits, depending on when you cash out. So if you don't invest, you lost the value of your money to inflation. If you do invest, you protect yourself against erosion due to inflation, but you are still giving up a portion of your profits to taxes. Sort of a catch-22, right? This is where debt comes in. Nearly every country treats debt as tax-advantaged finance. This means that you are not taxed on loans that you take out. Now if you just go around taking out loans and then spending the money however you want, eventually you're going to lose everything. The key is to take the debt and use it to purchase an asset, preferably an asset that does two things. 1. Appreciates in value, and 2. Generates enough cash to pay for the interest payments on the debt. Loans that are used to purchase these types of assets are known as accretive debt. A common asset that is purchased with accretive debt would be real estate. Loan balances typically get smaller over time as you make your monthly principal and interest payments, while the value of the asset that you purchased with the loan hopefully continues to increase through appreciation. At some point, you can sell the asset and cash out your appreciated equity, but then you will typically owe taxes on the profit, and you can no longer participate in the appreciation of the asset, which sucks. So how can you keep the asset, continue to enjoy the appreciation, and cash out your equity without being taxed? You get a bigger loan. As values increase, cash flow from the asset typically will increase as well, which means that the asset is well within the lender's maximum underwriting metrics. Therefore you can go back to the lender and ask for a larger loan that meets the original metrics. For example, if your original loan was limited to 75% of the value of the asset you purchased, within a few years it may be at 60% of the value of the asset as you've paid down the loan and the asset's value has increased. You can go back to the bank and ask them to give you a new loan at 75% of the new value of the asset. This larger loan is almost like selling the asset in that you get to cash out some of your equity, but you actually get to keep asset, continue to enjoy the appreciation, and the new money you just got from the bigger loan is not taxed. You can then take that new loan money and use it as equity to get a other loan and purchase a new asset. Now you have two assets that are both appreciating and throwing off cash flow, and you are able to purchase them without paying any income tax. You can keep doing this over and over as the asset continues to appreciate. This is the true secret to getting wealthy, using accretive debt to unshackle yourself from the ball and chain of income taxes that forever encumber salary earners. A quick example of what I've described above for the visual learners. You save up $250,000. This is your equity. Then go to the bank and get a $750,000 loan to purchase a $1 million property. Note that the loan is 75% of the purchase price of the property, as this is the bank's theoretical underwriting limit. A few years later, you've paid down the loan to $600,000, and the value of the property has increased to $1,500,000. You can go back to your bank and ask them for a new loan of $1,125,000, which is 75% of the new value of the property. You just received $525,000, $1,125,000 new loan balance minus $600,000 of existing loan balance, which is not taxed, even though it is cash that you can. You can take that $525,000 and use it as equity to get a new 75% loan to purchase a new property. In this case you could buy property up to $2,100,000 in value. Now you would still own your original property, currently worth $1,500,000, and you would also own the new property, worth an additional $2,100,000. You've just increased your wealth through appreciation and investment without paying any income tax on the gains, something that no salary earner or pure equity investor can brag about. Owning real estate, in particular, also offers the tax benefit of depreciation, which is a conversation for another time. In a nutshell, you can count depreciation, which is a non-cash expense, aka you're not actually losing money, as a loss, and use it to offset the income from a property and lessen your tax burden. Note that all numbers used are for the purpose of explanation and bear no relation to actual rates of appreciation or amortization. I am not a tax attorney or tax expert in any way, shape, or form. Please consult an expert before attempting to pursue any of the tax-advantaged strategies above. In addition, my experience is entirely in investing in the United States. My understanding is that debt is typically treated in a tax-advantaged manner by most developed economies. But I am not literate on the nuances of every country's economic legislation and environment.